Good morning, everyone. Thanks for joining us today. For those of you who don't know me, my name is Robert Baharian. I'm the Chief Executive at Ekam Capital, and joining me this morning is Jonathan Sim. John's our CIO. And the purpose of today is, given all of what's going on around the world and in markets, we wanted to set some time aside to give our investors an update of what we've been seeing over the last little while, what we're seeing in market at present, and also what we think all of that means for specifically for real estate credit. We want to go for half an hour. We want to be pretty sharp on the timing. The deck is quite full. We're not going to get through the entire deck. We're happy to circulate this post the webinar to those that have registered. But what we're going to do, before I do get started, general disclaimer, everything that we talk about today is not personal advice and is general advice. You should go seek financial advice from a registered financial advisor. To kick things off, we want to spend the next 15 or 20 minutes covering 2025, how that set us up for 2026. We want to talk about the macro. We'll talk more specifically about Ekam Capital, what we're doing, and how we think we're adding value to investor portfolios. We'll talk about the evidence, some of our numbers. We'll talk about 2026. But we also do want to dedicate at least 1/3 of this morning to Q&A. So there is a Q&A button on the ribbon on Zoom. So please feel free to ask questions and we'll do our very best to get to them. We've got a handful of questions already from advisors we've been speaking to that we thought would be relevant for today. So in the absence of any questions, we'll certainly cover off some of the things that we're already hearing from advisors and investors in the country. So on that note, I'll hand over to John, who will give us a rundown of 2025 and talk about where we are in market at the moment. Thanks, John.
Thanks, Rob. Look, 2025, we saw a lot of resilience in 2025 post-COVID. A lot of what was happening when we were in 2025 was working out, where things were going. There was a few impairments in the portfolio that our underlying managers were working through, but altogether, we managed to come out of that fairly unscathed. There was no issues within our portfolios. Most of our managers managed to work out of those situations quite effectively. They had strong workout teams and capability to work out of those situations.
That wasn't true first half of 2025. 2025, the numbers were much higher and we started to see problematic assets in portfolios, but that got cleaned right out.
100%, yeah. So we were left with maybe one or two problematic loans, which took a little bit longer to work out. But yeah, definitely no impairments over the course of 2025. What we ended up seeing towards the end of 2025 was an increase in appetite from market, actually. People wanted to start doing business again. Inquiries were up. It looked like things were getting fairly positive towards the end of 2025. And as we all know, the last quarter, with what's, been at the top of everyone's mind with Iran and the war and the Strait of Hormuz, has added a little bit more volatility to markets and a bit more of a spanner in the works in terms of where things were going.
Can we talk about that a little bit? What are the implications? What are we seeing? What are managers seeing? What are they doing? What are we doing?
Yeah. So it's been quite of a mixed bag in terms of how this is all playing out. It's still fairly early in the piece, but increase in Brent crude prices and closure of the Strait of Hormuz has resulted in a bit of a supply shock. We've seen the cost of PVC pipes up from Reese up 36%. Cost of copper's gone up. Cost of concrete's gone up.
Yeah.
And we're seeing a lot of contractors and subcontractors start talking about fuel levies as well in terms of for construction.
But also others are using this as an opportunity to raise prices where in the past they may not have had that opportunity. So carpet suppliers, tile suppliers.
Everyone's using it as a bit of an excuse.
Yeah.
But what we're seeing now, we're talking to a few builders, QSs, project managers about how this is playing out in market. And what they're saying is they think the real impact net is probably going to be 3 to 5% over the course of the next 6 to 9 months. They believe, if you look at volatility today, it's all back low. They're saying it's a short-term market event. The straits will eventually open, and this is not going to be a long-term supply shock that's going to impact markets. To offset that as well on the demand side, as we're seeing that confidence from market pull away a little bit, there's not as much supply in terms of build projects for construction. That's causing construction firms as a whole to be a little bit more competitive. So net, they're talking sort of 3 to 5 at the moment.
Yeah.
So that's what's happening in the Straits. Immigration, we're looking at is still at all-time highs. We're seeing a lot of demand coming into the country. We were at a function on Friday where the Lord Mayor was saying Victoria has now overtaken New South Wales in terms of population.
Yeah, largest city.
So it's the largest city in Australia. And we're seeing, if we talk about Victoria, given we're here, we're seeing a lot of appetite from interstate buyers looking at Victoria as an opportunity to invest in, given fundamentally, the pricing is so far different from the rest of the other states. We're obviously still seeing, I think, from a confidence level, unfortunately, a higher tax overall in Victoria than we are seeing in the rest of the other states, which I think needs to probably adjust before we see a bit of an equilibrium shift in Victoria. But what I can say is New South Wales, Queensland, the rest of the other states where we're invested across have been doing very well over the past year.
Yeah, we might touch on our allocations, but Victoria and New South Wales, probably the most liquid, the most migrant-rich, population-dense cities are where we're invested in. And so from that perspective, it's been a bit of a tailwind for us. Yeah.
Speaking to agents over the last quarter as well, given what's happening globally, we're seeing a shift to higher quality cash flowing assets. So any assets in that defensive category with AAA grade tenants, non-discretionary cash flows are still performing really well with really strong cap rates on market sales.
The other thing that we've been seeing is I'm sure most of you have been watching property prices. A lot of suburbs and postcodes aren't really doing much if we're talking specifically in Melbourne Metro. But what we are seeing, and I'm sure you've seen as well, is lower cost products, so apartments, units, anything sort of that sub $1 million mark is doing extremely well. With interest rates where they are now, we'll talk a little bit about what margin the banks are putting on for borrowing. We all know borrowing dictates borrowing power, and borrowing power dictates how much buyers can raise their hand and bid at auctions. And given buyers are really restricted with that, we're seeing unit prices and apartment prices really start to shoot up.
Yeah. One thing that we've noticed, speaking to some NAB bankers the other day, they're putting 300 basis point margin on top of current interest rates when assessing serviceability for borrowing capacity. So when you're looking at that, the loans that are being approved now, we think credit quality is actually really high, just given that buffer.
If you can get the loan.
If you can get the loan. So we don't think credit quality, if you can get the loan, is a risk. But yes, borrowing power for purchases is unfortunately shrinking in this market at the current time.
Yeah. I think fundamentally there is, for anyone that's looking at the portfolio numbers, you'll see 65-70% of the portfolio is invested in residential real estate in some way, shape or form, whether it's a subdivision or whether it's funding civil works, construction of it all. A big chunk of it relates to to residential, and and we'll talk about it a little bit later, there's a fundamental undersupply in the number of residential dwellings in Australia, which is part of the reason why numbers and prices are still holding up. We're not seeing en masse large 10, 15, 20% declines, and that's partly because of the fact that there is a fundamental undersupply in stock in Australia, and specifically the largest or biggest city in Australia being in Melbourne Metro.
Yeah, but there's no doubt confidence is down with a couple of interest rates already passed through and potentially one more tomorrow. That is impacting on consumer and business confidence.
Taking some brokers last couple of weeks, they're just saying the assessments they're doing is it's really pushing borrowers now with the latest rate hikes. They're saying another one or two, and these guys aren't even going to be able to have any other discretionary spending other than being able to fund their mandatory minimum home loan repayments. So it really is, it might not appear tough out there for a lot of us, but for the outer ring, it certainly is proving really difficult at the moment.
Yeah, it's that sort of K-shaped economy that everyone
100%
is speaking about.
Yeah. Look, guys, we might talk a little bit about 2025 in review on the real estate fund. We recently published our 28 February numbers. That was a straight 10% double-digit return, net of all fees, 12 months ending 28th of February 2026, which brings the fund's investment inception numbers to 939. The portfolio is sitting really healthy, really deep from a facility perspective and on a number of other fronts. Total facility limits sitting at north of $6 billion, close to 500 individual investments within the portfolio. Investors are well and truly diversified, not only from a number perspective, but also from the number of financiers and managers that we're getting that access through. So when you do that, you start to get real diversity around investment committee, origination, credit policy, and you start to really build a neat portfolio in real estate credit by using some of the best in the business. Weighted LVR sitting at 65% and average remaining term at 5.2 months. One of the things I wanted to touch on really quick is the distributions and the returns month by month by month. The fund's now been running for 41 consecutive months, and that's something that we're extremely proud of. Every single month has been positive since inception. What you'll find is somewhat a volatile return per month. The reason being is we do not smooth out our returns and pay distributions for the sake of paying distributions. We will only ever pay out distributions when we are paid. And so therefore you'll start to see that get higher, getting close towards the end of the financial year. And so you'll have some ups and downs, but all in all, you can see the numbers there on your screen. This simply illustrates what I've just said in a slightly different way, but visually you're seeing that uptrend because you're compounding contracted credit. So unless things are going wrong, this should continue to track in the upper right-hand corner.
Yeah, just touching on that, Rob, what we are seeing, majority of our book is on floating rates. So what we are seeing is improved growth in our sort of performance numbers, and that's reflective of the last quarter. I think we can continue to see that tracking even higher over the next quarter, but we're not sort of forecasting that to get to sort of that 11% number. It's probably going to be another 50 basis points.
Yeah, as much as rates are going up, we are finding that the market out there in credit is extremely competitive. And so the ability for financiers to pass on all of those costs becomes a little bit difficult to the extent that there is a lot of competition going around. And so everyone's been hearing about margin squeezing and so forth. And so therefore, just because rates are going up 0.5%, 1%, it doesn't necessarily mean that investor returns should jump, not dollar for dollar, but basis point by basis point. And so that's something just to be mindful of and keep in the back of your mind. Do you want to talk about credit a little bit?
Yeah. Look, we believe private credit is becoming, just a structural front for in Australia as well. So in the US and Europe, private credit's a big part of capital markets. You can see from the graph here that private credit in Australia is continuing to grow, and we see this space getting larger and larger for us, especially in the where we're playing in the commercial real estate lending space.
And as a market becomes more educated and experienced with it, I mean, we're all seeing product come to market, and it's just taking time for investors to work out what the right structure is, who the right players are to back, and that'll just naturally take time. But fundamentally, we know this offshore, and Australia's following the same pathway. Offshore, you're seeing 60 to 80% of borrowing is done by non-banks. In Australia, those numbers are low double-digit teens, so there's certainly a long way to go. Do you want to talk about housing? I know we touched on it earlier, but maybe some specific numbers.
Yeah, look, I think the funding gap for housing is real. If you look at the numbers, the Housing Accord had an implied dwelling pace of 256,000 homes, but you look at what's actually commenced, that's quite a fair number off at 195,000. And I think that's actually even lower. I think the impact of the closure of the Straits of Hormuz pulled another 33,000 of stock out of the market. So there is a big gap in housing,
which fundamentally holds prices stable to the extent that you don't have enough supply.
Correct. Yeah.
Do we want to talk? Let's talk about private credit governance and how investors can start to differentiate different players and providers in the market. Most people have been hearing about what ASIC's been working on the last little while. So opaque fee structures and remuneration, related party transactions, valuation practices, and inconsistent disclosure and terminology. We still see that up until this day. We still see terminology and disclosure of different asset classes trying to be brought to real estate credit, and it sort of doesn't work. But I mean, we're moving in the right direction. Maybe, John, do you want to talk a little bit about how we're thinking about all four of these different areas that ASIC's been looking at?
Yeah, I mean, we've been harping on about this since we started the fund
4 or 5 years ago.
That's right. Before ASIC actually came out and did this study last year. A big part of what we do and when we set up the fund was structurally getting the right amount of information from each of our underlying managers. So if you look at inconsistency in disclosure and terminology, which was raised by ASIC, we've been big proponents of getting some consistency across the board. So all the 15 managers that we deal with are required to basically provide us a standardized report in terms of how they're disclosing their portfolios to us. And we've noticed over time that they're actually incorporating that into best practice policy and how they're actually reporting to the market as well, because they're understanding now that, hey, sophisticated investors want to see this level of data, this level of transparency in their portfolios. So they get a real understanding and a real clear picture of what they're actually invested in and what risk they're actually taking.
Yeah.
So we've been really big advocates of doing that. Valuation practices is also something that we're highly focused on, especially in this market environment. There is.
Can you give an example of that transaction? Talk about valuation and talk about valuation reports that we received and for what purpose.
Yeah,
so I think that's really telling when advisors are being told that there's independent valuations, but you got to dig a little bit deeper. Maybe just touch on that, please.
Yeah, that's right. Look, I think the devil's in the detail, and if you're not looking through underlying assumptions and understanding how these valuations are constructed, it's not worth the paper it's written on. We often see deals where we've asked for valuations, they've purported something in a paper and an IM to that's been pitched to investors. And that valuation is significantly different from what they've reported, whether that be for internal reporting purposes instructed by developers versus being instructed by the lenders themselves for first mortgage purposes, or just pulling market comparables which in our view have not been very comparable. So I think it's challenging for if you're not within market to get a full understanding of that, but that's something we're really focused on, just making sure that we understand the underlying assumptions.
So I think for advisors on the call, I think the really important thing is when you're being told that there's independent valuations, you need to look beneath that and find out who's instructed the valuations. What do the comparables look like? And you almost get to a point where you need to start interrogating the purported independent valuations. So there's a number of things that I think advisors need to be looking at and not just taking what is printed on surface on face value.
Not just advisors, anyone really.
Well, anyone. Another example, and we'll move on after this, is we were reviewing a particular manager who was disclosing that they were 0% in arrears on their loans, but when you scratch beneath the surface and you discover that all of their loans are in fact not even servicing, they're capitalizing interest loans, which means these loans aren't servicing anyway. And so therefore, of course, there will be a 0% in arrears. And things like technical defaults, we talk about inconsistent disclosure and terminology. No one's asking about technical defaults. Technical defaults are not, most managers, most financiers won't publicly disclose those. And so these are all questions that I think investors need to be asking. I'm just conscious of time. Do you want to really quickly talk about...
Maybe you could quickly talk about this one.
Yeah, I'll talk about this. We'll give a couple of transaction examples. We'll get to some questions. In terms of what Ekam Capital does, investors are seeing us, and advisors and investors are seeing us as almost an outsourced, specialized team where we are. The last 12 or 18 months, we'd spoken to 76 financiers and managers across the country. Just get rid of that. Across the country, we score them and rank them, and we rank them against each other. And so internally, we've got a ranking system, a ladder, we call it a ladder, of who we believe are some of the best managers around the country, who we think is not quite ready. And there's a number of criteria that we follow, and we can, for investors and advisors listening, we can talk about that separately. So selection is a massive part of what we do. Defensive structuring for us, the way we've set the portfolio up, whereby LVRs, we've got maximum 65%, minimum 70% has to be first mortgage. And I won't go through all the guardrails and protocol that we've set up in the fund. It's quite structured and academic to make sure that our investors are protected on a number of different fronts. We sit down with all of our managers every quarter at a bare minimum. We review the portfolio, we interrogate them, we update our scores and our rankings, and we recycle quickly. And what I mean by that is that with an average maturity profile of 5.2 months, cash is being returned quickly, and we're constantly redeploying to get up to market opportunities, valuations, and so forth. So we're not seeing historical loans in the portfolio. One of the things we'll start reporting on, and you might see other managers reporting on now, is vintage. Commercial real estate doesn't report on vintage. I'd like to think we'll probably be one of the first that publicly report on that. You'll see other managers follow suit. Our vintage sits at 2025. Over 90% of our portfolio has a 2025 vintage. What that means is they're mostly on floating rates. Some of them are fixed on a high rate. They have all been assessed at higher rates. Valuations are probably lower than what they might be today, or maybe equivalent to what's been going on. So there's real structure and process around what we're doing and how we're managing money. Because for us, maintaining the capital and principal is first and foremost the most important thing for our investors.
Yeah, and just to touch on that, look, yeah, we're if you look at our yield to maturity on our portfolio at 5.2 months, what that actually means for us is that every 5.2 months, you've got to go through a revaluation.
That's right.
Event, which effectively means you're marking to market your valuations on a shorter time duration, which actually protects the portfolio from that duration risk and having a probability of loss.
That's right. And maybe just finally, for the avoidance of any doubt, Ekam Capital we're not out there originating loans. We're not originating loans and then selling them down to our investors. We are a capital allocator. We are meeting with some of the best financiers around the country, and we are putting them through a due diligence process. We are comparing them and ranking them to the other 74 that we've met over the last 12 to 18 months. And we're making well-informed decisions as to who and how much and when we allocate to them in our portfolio. I'll skip a few of these slides, just conscious of time. No active questions on the chat at the moment. So, John, maybe do you want to finish up on a couple of two live transaction examples?
Yeah, we'll just use these illustrated transactions just to show you how we're looking at portfolio risk. So the mezzanine exposure that we've been taking over the last year has been really low. That's sub 10% of our fund in mezzanine loans. If you look at this one as an example, we had a 40% LVR mezzanine loan to a facility for a land subdivision in Tasmania. That we felt was a fairly conservative position with a really high quality manager with a strong workout team. Lo and behold, that one went into a bit of trouble. And what we found was backing that manager with that strong workout team, they were able to put a resource on that deal as soon as it hit a bit of trouble, a full-time resource to work through that project. There was a bunch of complexities with council and things that they had to deliver to activate the site, which they had to take control of and work through to be able to realize value. Quite a prolonged process, but yeah, we managed to get out of that one with default rates and they rehabilitated that project and just showed the quality of their workout capability as managers.
But I think that was also sized up right to the extent that if it went the other way and it didn't play out the way we thought it would play out, it was sized up in such a way that it wouldn't impact portfolio performance and return. Right. We'd get our capital back, but we may not have got our full interest and default interest back. But this one played out the way we thought it would play out, and now with the benefit of hindsight, it worked out well.
That's right. Another good example that we went through this year was just an example of how we're actively managing and how we're looking through portfolios. We get full look through on all portfolios. We won't invest in a portfolio that's a black box, something that we can't interrogate. We had an example of a manager who, if you were looking at this portfolio from their reporting in market, it would look highly diversified, 30 plus exposures in there.
Yeah.
But because of the way that we are obtaining our reporting in this standardized fashion, we were able to demonstrate that, they actually had a developer concentration risk of about 49% within their portfolio. So, you really had to dig through underlying SPVs of each of these investments in their portfolio to work out who the developer was behind that. And you realize actually you're not as diversified as you thought you were.
And we really like the manager. We back the manager. We'll continue to back the manager. But what we're able to now do is instead of maintaining exposure to that degree of concentration, what we actively have been doing month by month is watering that manager down, not by redeeming, but because we've got 15 managers we can allocate to. We've been strategically rebalancing the allocation so that the exposure there will continue to come down until the managers sort themselves out, and we're confident they will. But for the moment, we think it's unnecessary risk to continue to expose ourselves and our investors to that. We've got one question. Brian, go ahead.
Yeah, Robert, thank you, and Jonathan for your time. My question is probably a bit granular. I'm just interested in Ekam Capital's appetite for build-to-rent developments, particularly in Melbourne City.
Yeah. Okay. Thanks, Brian. John?
Yeah, Brian, there's been a big wave of build-to-rent. What we're finding in terms of who's funding these developments is really the institutional side of the market. So some of the larger players in the market, they're getting institutional capital lines from offshore at far more effective costs of capital than we would be comfortable providing to back these projects in. Where we find we're most competitive and we add the most alpha to our portfolio is in the mid-market space. We find at the top end of the market with your Qualitases, your Metrics, and other players in that space, you're looking at much larger project sizes, 100 mil plus project sizes, where we find that our view is that if liquidity starts pulling out of the market, those are the projects, and we've seen this in the past where you just don't have the depth of buyer pool at that larger end to sort of maintain effective pricing in market. So we find those bigger projects, if anything goes wrong, start having to take big discounts to clear. And so in this mid-market space, call it 5 to 50 million, we're finding a much larger depth of capital and much more liquidity in that space. And that's sort of the space that we're playing in. So when we talk about build to rent, it does sit on that more institutional side of the capital curve.
And it's not only built to rent, you've got large projects, whether they're office, medical, or anything like that, those large institutional style deals, when things go wrong, they take a really long time to play out. You've got transactions sitting in market that we know of that have been taken over by the lender, and you can't find buyers. And these are hundreds of millions of dollars worth of assets, or in fact, 90, 100, 110 million dollars worth of assets, and it's not a deep market to be able to transact really quickly. On that note, conscious of time, we're at 10:35. We will wrap up. We will be available for any further questions if anybody has any follow-up questions. Brian, thank you for your question this morning. Thanks again for attending. We will circulate the deck after today, round through to those that have registered. The recording may even be available, but if you don't, just let us know. We'll make it available. Thanks again for attending, and we'll chat soon.